We welcome you to our classes. Today's topic is distinction between capital expenditure and revenue expenses. Capital expenditure is expenses made for the purchase of assets, fixed assets like furniture and fittings, machineries, motor vehicle, etc. And the other thing is the benefit of which will be prolonged to more than one reporting period. It is not necessary it should be purchased as a whole. It can be constructed like building constructions and any substantial improvements which are made to the assets, which will give the better utility value of that asset, also will fall under capital expenditure. Opposed to this, revenue expenditure means all the normal expenses like purchase of inventory, rent, electricity, salary. A small illustration is shown here. If you look at it in the blue, a car is a capital expenditure, whereas repairs, maintenance, purchasing of tires, wipers, etc. will fall under revenue expenditure. Let's learn about capital income, revenue income as well. Capital income means maybe a sales proceed of fixed assets and not the regular income. Revenue income is the regular income like sales proceeds, sales of services, etc. Since this is derived from the main operation of the business, this is also known as operating revenue. But there can be some small activities like say selling of scrap value items, etc. will fall under sundry income or non-operating revenues. In English language, revenue is also known as income. Income is also known as income. Depending on context, income, mostly known as profit or bottom line in the P&L, whereas revenue refers to the sale proceeds, etc., and normally top line, which will be expressed in net form as gross profit. To explain further, we will look at few MCQs. The question, what would be treated as part of the capital expenditure of the purchase of a building? 1. Cost of purchases. Yes, this will fall under capital expenditure. 2. Installation of air conditioning needed for the machinery in the building. So this is obviously an improvement of the building and the utility value of the building goes up. Therefore, this is also a capital expenditure. 3. Insurance of the building. This is a revenue expenditure as it is relevant only for the insured period. Even if it exceeds 1 day, it will get expired. Therefore, the answer is 1 and 2. A is the answer. Okay, the next question. Recording the purchase of computer stationery by debiting the computer equipment at cost account would result in, please note, computer stationery, a revenue expenditure, computer equipment, a capital expenditure. A revenue expenditure by mistake shown as a capital expenditure, what impact it will have on the accounts. First, when the expenditures are shown less, obviously the profit will get overstated. In the statement A and C, we see this situation. Similarly, when you add something incorrectly to a fixed assets, so it will show as higher than it should be. Therefore, it will be an overstatement of fixed assets. Therefore, the answer is A. Okay, the next MCQ. From the following, which shows capital expenditure clearly? A. Fixed assets, capital expenditure, including repair and maintenance expenditure, those are revenue expenditure. Therefore, this statement is incorrect. B. Assets of high value. A furniture purchased for 10,000, at the same time a machinery purchased for 10 million, both can be fixed assets, capital expenditures. Therefore, this statement is also incorrect. C. Connected to the issue of share capital is totally incorrect, except for the word capital. There is nothing common in this. D. Purchase of fixed assets, correct, and also developing the same, that also will come under capital expenditure. Therefore, the answer is D. The next question, the table shows part of the statements of financial position. That means balance sheet of a business. Here, two comparative figures are given. Non-current assets, less accumulated depreciation at book value. Students, please note, this is the presentation for non-current assets. Further, they say, during the year 2020, depreciation charge was 40,000, non-current assets purchased new 105,000, loss on sale of non-current assets 10,000. In order to deal this situation, we will have to create a disposal of non-current asset account. For that, we need cost, accumulated depreciation, and also the sales value. But none of these are given directly, so we will have to find out. Opening balance of 190, there's a new purchases of 105, therefore it should have been 295, but it is only 245 shown as closing balance. So obviously 50,000 have been removed, which is the cost of the asset disposed. Next, accumulated depreciation, opening balance 75, charge for the year is 40,000. It should have been 115, but it is shown only as 90 as closing balance. Therefore, the difference should be that of the asset disposed. As you see, the cost have been brought to the disposal account. Similarly, the depreciation, and they say the loss of the sale is 10,000, and they want us to know how much is the sale proceed is. So as you see, it is the difference 15,000. Therefore, the answer is A. Now the next question, non-current assets 250, usual economic life 25 years, estimated residual value 10. Depreciation provided on a straight line basis. Note, straight line basis. After 10 years, the asset sold for 120, disposal cost 20 are incurred. Loss on disposal is. 4 answers are given. First, the students must resolve whether to do depreciation for 250,000 or 250 minus 10, residual value 240,000. 250 or 240. Since this is straight line basis, the residual value will be recognized. Therefore, it has to be 240. Therefore, depreciation for 10 years, 96,000. If you deduct it from the cost of 250, it will be 154,000. Therefore, NBV, net book value, will be 154,000. Next, disposal income 120 minus disposal expenditure 20. Therefore, net disposal income is 100. Compare with that, the loss will be 54,000. Therefore, the answer is D. The final question is, a company provided the following information. Revenue for the year 390, year-end non-current asset at cost 260, year-end accumulated depreciation 65. What was the non-current asset turnover? That is to say, how many times the non-current asset has turned over in order to generate the revenue. Turnover 390, net non-current asset 260 minus 65 is 194, therefore 2 times. The answer is D. That's all for the day. Just as a passing remark, we show you this. This is the way you are expected to show in the balance sheet the non-current assets. To get familiarized with the new words used here, tangible assets refers to an asset which has a physical existence, like land and building, machinery, motor vehicle, etc. Intangible assets, they are also assets like goodwill, copyright, royalty, etc. Natural resources, these are depleting assets like forest, quarry, mine, etc. Dear student, as you all know, these classes are provided to you by our YouTube channel, SL Account School. So we kindly request you to subscribe, share, like, and promote it among those who are interested. Thank you very much.